Alright guys, welcome back to another trade breakdown video. Now let's dive into the first trade, which focuses on spotting false breakouts after an AMD cycle. Obviously the AMD here stands for Wyckoff's accumulation, markup and distribution phases. Now looking at this 15-second CS chart, you'll notice that the market saw a sharp drop right after this apparent fake breakout. Obviously, the key question here is how can we tell that it's a fake out? Well, for starters, the whole scenario has Wyckoff's AMD written all over it. You see, down here, the market went through an easily identifiable accumulation phase. This was then followed by a markup phase, a classic, I would say, a market maker pound model designed to lure in chasers. As expected, the third phase is distribution, which brings us to this point on the chart. Now, when the price pushed above the previous high here, it created the illusion of a breakout. But in reality, this was just a liquidity grabbing move by the market makers. They were essentially busy up here buying all these buy stops above the supposed break level, while simultaneously targeting all this already generated or existing liquidity to the left of the chart. The same fake breakout scenario after this reversal repeats itself. We are now basically up some 8 points on the chart, and this 41 level area seems like a pretty decent support zone to me. So the action is definitely looking better for some potential upside off of this level. And as you can see, we got another push up, retraced into this imbalance zone, rebalancing it, pushed up again, experiencing another fake breakout. Now, the key takeaway from these consecutive fake moves up is that false breakouts can highlight areas where smart money aims to grab liquidity, giving you an edge in the market. Now, as we move to the right section of the chart here, notice how this new high is followed by another push to the downside. However, unlike the previous high, we don't see the same level of sharp decline. Instead, the market seems to find support above the 47 level, suggesting we might be in for a period of consolidation before the next move. Well, what's the next move? That's a reasonable question. The next move becomes quite readable in my view when you consider the market's failed attempt to reach equal highs here. Additionally, this failure is followed by a break in market structure, leading the price to retest and eventually break below the consolidation zone support level. As you can see, I placed my short as soon as that happened. I did experience some drawdown here after my order was filled. The bounce though was relatively weak and short-lived, which opened the door for another break in market structure and further decline into the 41 support band here. At this point, after my first target gets hit, things get a bit choppy as retail money enters the mix, but eventually the price, after these rebalancing moves, makes its way down to the mid 36 sell rate level, hitting my last profit target. I also tried adding another contract at the 46 level, but somehow I didn't get it. Overall, I think that this trade is a good example of how understanding the AMD cycle combined with trading against the direction of failed breakouts and other market structure components can lead to a profitable trading strategy. Another thing I'd like to add here, guys, is that you have to realize that these strategies aren't something you'll master overnight. In fact, it takes a ton of time and practice to spot them in real time. So here is what I would suggest. Start by back testing. You have to basically dive into those charts and really look for these patterns. When you're actually trading, at the same time you have to journal like crazy. Even if you don't take a trade, look at the chart and think, hey, I think this is an AMD cycle that might lead to a fake out up here. what you do next is you immediately snap a screenshot and jot down your thoughts. Then after the trade plays out, write about why it did or didn't go the way you expected the trade to go. I think that this reflection is key. When you take the time to mull over your thoughts each trading session, you are gaining knowledge and improving. But if you are not engaging in such a manner, if you are just basically glancing at the market day after day without questioning your entries or wondering why things happened, you are not going to get better. Your results stay the same, and there is no other way around it. You'll just be stuck in a rut. I mean, it's simple as that. That's why I think it's all about learning from your experiences. I think that by really digging into why you entered that specific trade and how the market responded, you are training your brain to pick up on those subtle cues that make all the difference. So don't just watch the market. Engage with it, question it, and learn from it. That's how you'll start to see real progress in your trading game. Okay, now that we have covered this first trade, let's move on to the second one. We will dive into the reasoning behind my decision to take this trade and how it all played out. So after seeing this particular price structure on the 1 hour time frame emerge, where the market, after retracing this cluster of highs or this area of internal liquidity, reverses and nosedives, eventually creating on the way down another equal low. We then make a 180 into this imbalance zone up here, drop again, and then retrace into another imbalance zone. So following this price action, which really got my interest, I figured it would be helpful to like switch things up and take a closer look. So I hopped over to the 100 tick chart, and let me pull it here. So I hopped over to the 100 tick chart to sort of fine-tune my approach as I started analyzing further this area of interest, which again we identified on the higher 1 hour time frame. And now the first thing I noticed after the switch here are these consecutive breaks in market formation or market structure. In my view, the first break doesn't hold much significance, and this is because unlike the second break, it lacks depth and bar impulsiveness. Generally, the more pronounced or forceful a break of market formation is, the higher the chances that the price will get affected and thus keep moving in the direction of that break. And now, one thing to note here is that the best entry point, green-wise that is, for a short would have been at the top of this redistribution segment. This segment obviously formed as a result of this AMD cycle, which led the price into this imbalance area. However, given that I was looking at the 100 tick chart instead of the 5-minute or 1-minute time frame, I felt like I needed some extra confirmation here before jumping into a short position. Also, at this point, the price is bouncing around the VWAP, which clearly indicates a lack of direction. Now, one thing to note here, guys, is that I decided to enter short only after the price broke below the base of the redistribution segment and then slightly retraced first into this flip level and then into the imbalance zone. At this point, we have price below VWAP. Now, this VWAP positioning, which is obviously another way of defining trend, along with other structural elements I mentioned, gave me that extra confidence I needed to enter the trade. It's all about thinking rationally, guys, instead of emotional. And as you can see, there is minimal drawdown after the fill, with the price hitting both targets. By the way, the second target was placed above the 16 level to measure the equal highs we spotted on the 1 hour time frame. And guys, if you want to like develop and learn similar price action strategies, make sure to catch my next video where I demonstrate these high probability entries or techniques in action. Alright gang, thanks for watching, and as always, hope to catch you all in the next one.